If you're planning to withdraw 4% from your retirement account starting next year, the math might be exactly right, and the result could still cost you $50,000 you didn't need to lose. That's not a percentage problem. It's a sequencing problem, and almost nobody outside a fee-only planner's office talks about it. Most rankings of withdrawal strategies compare percentages side by side, 3% here, 5% there, and tell you which number keeps your money alive the longest. What they skip is where each dollar comes from. Your 401k, your Roth accounts, and your regular brokerage account might all show similar balances on a statement, but the IRS treats them as three completely different animals. Pull from the wrong one at the wrong time, and you can trigger what's known as the tax torpedo, or trip a Medicare surcharge called IRMAA that adds thousands to your healthcare bill for an entire year over a single miscalculated withdrawal. I've watched retirees do everything right on paper, hit their number, retire on schedule, and still lose tens of thousands of dollars, simply because nobody told them the order mattered as much as the amount. Today we're ranking the 5 most popular withdrawal strategies, from worst to best. But we're also going to fix the piece most of these rankings leave out: the sequencing error hiding underneath even the best strategy on this list, the one that can quietly cost you $50,000 over a decade. If you're between 55 and 65 and want to keep your effective tax rate under 15% while you draw down accounts you spent 30 years building, subscribe. This channel builds around the math the standard advice leaves out. Start with the strategy that looks the safest and behaves the worst. It's called the constant percentage method, and it means withdrawing a fixed percentage of your portfolio's current value every single year, say 5%, no matter what the market did. Here's the problem. If you have $1 million and pull 5%, that's $50,000 for the year. Fine so far. But if the market drops 20% that same year, your portfolio falls to $800,000, and your next withdrawal, still 5%, is only $40,000. Your income just fell $10,000 in a single year, and you didn't choose that. The market did. That's called volatility decay, and it's the mechanism most rankings gloss over. The percentage stays constant. Your actual paycheck does not. You didn't spend 30 years building this account, so your grocery budget could be decided by a bad week on Wall Street. But that's exactly what a strict constant percentage rule hands you. And nobody mentions that part on the way in, either. Here's the twist most people miss. The math behind this method is actually the most defensible of the 5. Academics like it, because it can never fully drain your account to zero. That's also exactly why it ranks worst for real people. A strategy that protects the portfolio at the expense of your monthly income isn't protecting you. It's protecting a number on a screen. What you're actually trading away is stability. You get a portfolio that technically survives longer, in exchange for years where your spending power can swing 15% or 20% without warning. For someone living on a fixed income in their 60s, that swing isn't academic. It's the difference between a normal grocery run and cutting corners for months while you wait for the market to recover. Some retirees try to soften this by capping how far the withdrawal can swing in either direction, a ceiling and a floor built around the same percentage. That helps, but it also means you're no longer following a pure, constant percentage rule. You've quietly borrowed an idea from a better strategy. But what if you skip the swings entirely and just live off the income your investments generate, without ever touching the principal? That sounds safer on paper. It carries its own blind spot, and it's ranked just one spot better. Ranked fourth is the dividend-only approach. Live entirely off the dividends your portfolio pays and never sell a single share. It feels safe because you're never touching your principal. Emotionally, that matters. Nobody wants to watch their account balance shrink every time they pay a bill. The problem is the yield itself. The S&P 500 currently pays out somewhere around 1.3% to 1.5% a year in dividends. To generate $50,000 a year in dividend income alone, you'd need a portfolio worth well over $3 million. Most retirees don't have that, so they reach for higher yield alternatives instead. That's when a 2% yield chase turns into a 6% or 7% yield chase, and a yield that high rarely comes without extra risk attached. That reach is where the trap opens up. High-yield REITs and dividend-heavy funds can push yield up to 5% or 6%, but dividends aren't guaranteed. In 2020, several major energy companies slashed their dividends by more than half in a single announcement. Retirees who built their entire monthly budget around that income had to rebuild it overnight in the middle of a pandemic, with markets in freefall. A dividend cut doesn't ask your permission, and it doesn't wait for a convenient month. Even the dividends that do survive are rarely the highest earners. Companies with the highest yields are often the ones with the least room to grow, borrowing today's stock price to fund tomorrow's payout, which caps how much your income can realistically rise over time. I've seen people load up on high-yield stocks in a regular brokerage account, thinking dividends were the ultimate retirement hack, right up until they saw their tax bill. Dividends from a taxable account to get taxed as income the year you receive them, whether you spend the money or reinvest it. Chase a high enough yield, and you can push yourself into a higher tax bracket without ever selling a single share. What you're really trading here is control for comfort. You avoid the discomfort of selling shares in a down market, and in exchange you hand your income over to whatever a company's board decides to pay you this quarter. That's not a decision you're making. It's one you're outsourcing. You didn't retire to manage someone else's payout schedule. If dividends alone don't cover the bills, a lot of retirees turn to something that guarantees an income floor no matter what the market does. It's the strategy people love to complain about. And it still ranks ahead of dividends for one specific reason. Ranked third is the annuity floor, and it works differently than anything so far. Instead of drawing income from a portfolio, you use part of your savings to buy a single premium immediate annuity, essentially creating a paycheck that arrives every month for the rest of your life, no matter what the market does. Think of it as a personal pension you build yourself. Medicare Part B costs $202.90 a month in 2026, and an annuity that guarantees even $1,500 or $2,000 a month covers that bill and more before you touch a single dollar from your investments. Your basics costs get paid regardless of whether the market is up or down that year. That guarantee matters more than it sounds. Between 2000 and 2002, the S&P 500 fell for 3 years in a row, something that hadn't happened since the Great Depression. Retirees pulling income from a shrinking portfolio during those 3 years, especially early in retirement, permanently damaged how long their money lasted. An annuity floor sidesteps that risk entirely for the portion of income it covers. Inflation is the other catch. A basic single premium annuity usually pays the same fixed dollar amount every month for life, so the buying power of that check quietly shrinks a little more every year prices rise. Here's what changed the math recently. For years, retirees with a government pension who also qualified for Social Security saw their benefits reduced under two older rules. Those rules were repealed in January 2025, so retirees with a pension now keep their full Social Security benefit on top of it. Some people who used to lean on an annuity purely to replace lost Social Security income no longer need to lean on it quite as hard. None of that erases the real cost of this strategy. Once you hand money to an insurance company for an annuity, that money is largely gone. You lose access to it. If you need a large lump sum later for a health emergency or to help a family member, that flexibility isn't there anymore. You've traded liquidity for certainty, and for some people that trade is worth it. For others, it locks up money they'll wish they still controlled. That's a real trade, not a hidden one, and it deserves a clear-eyed decision rather than a reflexive no. Annuities give you a floor. They don't give you a ceiling. The next strategy on this list is the one most people already know by name, and it just got a significant update. Ranked second is the strategy most people have already heard of, the 4% rule. Withdraw 4% of your portfolio in year one, then adjust that dollar amount for inflation every year after. It's simple, it's been taught for decades, and it's due for an update. The rule came from a financial planner named Bill Bengen in the 1990s. He looked at historical market returns and found that withdrawing 4% in year one, then adjusting for inflation each year, kept a portfolio alive for at least 30 years in nearly every historical period he tested. That's the number that made him famous. What most people don't know is that Bengen himself has since said the number could realistically run closer to 4.7% or even 5% for some retirees, depending on how their money is invested. That's a wider range than most retirees ever hear about. That higher number usually assumes a well-diversified mix of stocks and bonds, not a portfolio sitting entirely in cash or a single index fund, so the exact percentage that's safe for you depends heavily on how your own money is actually invested. The inflation adjustment works like this in practice. Say you start with $1 million and withdraw 4%. That's $40,000 in year one. If the following year's cost of living adjustment runs at 2.8%, your year two withdrawal isn't still $40,000. It's $41,120, an extra $1,120, so your income keeps pace with rising prices instead of quietly losing purchasing power. That sounds stable, and it has one serious blind spot called sequence of returns risk. The rule assumes an average return over 30 years, but averages don't protect you in year one. If the market drops hard in the first 3 years you're withdrawing money, you're selling shares at depressed prices to fund your income. And that early damage compounds for the rest of retirement. Historical testing shows the classic 4% rule fails to last 30 years in roughly 18% of the scenarios researchers have modeled, almost always because of bad timing right at the start. The 4% rule is essentially a rear-view mirror. It tells you what would have kept you safe if you retired in 1968 or 1985. It doesn't know what the market is about to do the week you actually stop working, and that gap between historical safety and your specific starting point is exactly where retirees get hurt. It's still a solid rule, better than a straight percentage, better than dividends alone. But if a fixed 4% is too rigid for markets that don't move in straight lines, the top-ranked strategy solves that specific problem. It behaves less like a formula and more like a thermostat, adjusting your spending automatically as conditions change. Less rigid, more responsive, and built for exactly the kind of market swings retirement actually delivers. Ranked first is the Guardrails approach, sometimes called the Guyton-Klinger method, after the researchers who built it. Instead of picking one fixed percentage and sticking with it no matter what, you set guardrails around your withdrawal rate and adjust your spending only when you cross one of them. The mechanics work like this. You start at a 5% withdrawal rate, higher than the traditional 4% rule allows, because the whole point of this method is flexibility instead of rigidity. If the market drops enough that your current withdrawal rate climbs to 6%, a 20% jump from where you started, that's your capital preservation guardrail, and you respond by cutting spending 10% until the ratio comes back into a safer range. If the market performs well, and that same withdrawal rate falls under 4%, a 20% drop, that's your prosperity guardrail, and it means you can give yourself a 10% raise. That flexibility is the entire reason this method outperforms a fixed rule over a full retirement. Notice this starts at the same 5% that ranked dead last as a constant percentage rule earlier. The number isn't what makes guardrails different, the response is. A flat 5% rule keeps taking 5%, no matter what happens to your account. Guardrails treats 5% as a starting point and builds in a trigger that forces a course correction before the damage compounds for years. Same starting number, a completely different outcome, because one rule adapts and the other doesn't. Picture a $1 million portfolio that drops to $800,000 during a market correction. Under a rigid 4% rule, you'd keep pulling the same inflation-adjusted number regardless, digging the hole deeper every month the market stays down. Under guardrails, the drop triggers a specific calculated response. Trim spending by 10% until the numbers realign, instead of guessing or panicking. You have a rule that tells you exactly what to do and when to do it. That's the whole appeal. A rule replaces a guess. I have a friend who's used this system for years, and he calls his prosperity guardrail his grandkids' Disney fund because he only spends that extra money when the market itself gives him permission to spend it. That's the emotional shift this method creates. You stop reacting to the market out of fear and start responding to it based on a plan you set up in advance. This isn't a perfect system. It requires you to actually track your withdrawal rate every year and follow the rule even when cutting spending 10% feels uncomfortable in the moment. Plenty of people set guardrails and then ignore them the first time the market gets scary, which defeats the entire purpose. The system only works if you're willing to actually use it. But even the best withdrawal strategy on this list can get quietly undone by something that has nothing to do with the market at all. It's the piece almost no ranking video mentions, and it's where the real money gets lost or saved. We promised you the $50,000 sequencing secret. Here it is. Here's the piece the standard rankings leave out entirely. All 5 strategies above tell you how much to withdraw. None of them tell you which account to pull that money from first, and that single decision is where retirees quietly lose or save tens of thousands of dollars. The IRS doesn't see your accounts as one pool of money. It sees 3 separate buckets, each taxed completely differently, and the order you draw from them changes your tax bill every single year of retirement. The general order that keeps most retirees in a lower bracket looks something like this. Pull from your regular taxable brokerage account first, because long-term capital gains there are often taxed at 0% or 15%, sometimes lower than ordinary income tax rates entirely. Next, draw from tax-deferred accounts like a traditional IRA or 401k, but only up to the top of the 12% or 22% bracket, not a dollar further. Save Roth withdrawals for last, since they don't count as taxable income at all, which gives you a lever to pull in years you need extra cash without pushing yourself into a higher bracket. That last lever matters more than most people realize, because of a cliff most retirees have never heard of. In 2026, Medicare's IRMAA surcharge on Part B premiums ranges from $284.10 to $689.90 a month, depending on your income 2 years earlier. Pull just $1,000 too much from a traditional IRA in the wrong year, and you can cross an income threshold that adds more than $4,000 a year in extra Medicare premiums for a couple over a single withdrawal decision that took 5 minutes to make. That's not a one-time mistake either. Push your income over the same threshold 2 years running, and you're paying that extra premium 2 years running, since IRMAA is based on a 2-year look-back on your tax return. There's a newer tool that can soften this. Retirees 65 and older can now claim an additional $6,000 deduction per person under a recent tax law change, on top of the standard deduction, which lowers your taxable income and gives you a bit more room before you hit the next bracket or the next IRMAA threshold. That extra room becomes especially useful once required minimum distributions kick in at 73, forcing withdrawals from tax-deferred accounts, whether you need the income that year or not. Run these two paths side by side over a 10-year retirement. One retiree sequences withdrawals deliberately, taxable first, tax-deferred to the bracket line, Roth last. The other pulls randomly, whatever account is easiest that month. Same total spending, same market returns, same starting balance. The difference between them, purely from sequencing, runs about $50,000 in unnecessary taxes and Medicare surcharges. Same money, same market. The only difference is the order. So here's the full ranking, worst to best. Constant percentage sits at the bottom because it protects the portfolio at the cost of your actual paycheck. Dividend-Only ranks fourth because chasing yield can quietly wreck your taxes and your income stability at the same time. The annuity floor comes in third, trading liquidity for a guaranteed baseline that covers the essentials no matter what markets do. The updated 4% rule takes second, a solid, well-tested approach that still carries some sequence of returns risk baked in. And the Guardrails approach ranks first because it adjusts to reality instead of asking reality to match a fixed number on a spreadsheet. None of that ranking matters as much as the sequencing decision underneath it. Retirement isn't really about chasing the highest return. It's about building the highest certainty you can, for the income you'll actually depend on for the next 20 or 30 years. If seeing the tax side of this math exposed a gap in your own plan, that's a completely normal thing to notice at 55 or 60. It just means there's still time to fix it. Subscribe if you want more of this kind of math laid out plainly, the kind most rankings skip straight past.